What is financial literacy? Financial literacy is the cognitive understanding of financial components and skills such as budgeting, investing, borrowing, taxation, and personal financial management. The absence of such skills is referred to as being financially illiterate. Do not forget to like, share, subscribe and ring the bell for more videos. According to the Financial Industry Regulatory Authority, FINRA, about 66% of the American population is considered financially illiterate. Being financially literate allows an individual to be better prepared for specific financial roadblocks, which, in turn, decreases the chances of personal economic distress. Achieving financial literacy is crucial in today's society due to everyday facets of life, such as student loans, mortgages, credit cards, investments, and health insurance. Fundamental components of financial literacy. Financial literacy consists of several financial components and skills that allow an individual to gain knowledge regarding the effective management of money and debt. Below are the fundamental components of financial literacy that should be learned. 1. Budgeting. In budgeting, there are 4 main uses for money that determine a budget: spending, investing, saving, and giving away. Creating the right balance throughout the primary uses of money allows individuals to better allocate their income, resulting in financial security and prosperity. In general, a budget should be compassed in a way that pays off all existing debt while leaving money aside for saving and making beneficial investments. 2. Investing. To become financially literate, an individual must learn about key components in regards to investing. Some of the components that should be learned to ensure favorable investments are interest rates, price levels, diversification, risk mitigation, and indexes. Learning about crucial investment components allows individuals to make smarter financial decisions that may result in an increased inflow of income. 3. Borrowing. In most cases, almost every individual is required to borrow money at one point in their life. To ensure borrowing is done effectively, an understanding of interest rates, compound interest, time value of money, payment periods, and loan structure is crucial. If the criteria above are understood sufficiently, an individual's financial literacy will increase, which will provide practical borrowing guidelines and reduce long-term financial stress. 4. Taxation. Gaining knowledge about the different forms of taxation and how they impact an individual's net income is crucial for obtaining financial literacy. Whether it be employment, investment, rental, inheritance, or unexpected, each source of income is taxed differently. Awareness of the different income tax rates permits economic stability and increases financial performance through income management. 5. Personal financial management. The most important criteria, personal financial management, includes an entire mix of all of the components listed above. Financial security is ensured by balancing the mix of financial components above to solidify and increase investments and savings, while reducing borrowing and debt. Achieving an in-depth knowledge of the financial components discussed above guarantees an increase in an individual's financial literacy. Financial literacy. Importance of financial literacy. Attaining financial literacy is one of the most important things an individual can do to ensure prolonged financial stability. Listed below are some real-world facts that should emphasize the overall importance of attaining financial literacy. It is estimated that about 78% of Americans live paycheck to paycheck. More than 189 million of the American population own credit cards. On average, credit card owners own about 4 cards each. Student loan debt is about $1.5 trillion for more than 44 million borrowers. Credit card debt levels are at a record high of $1.04 trillion. Overall, Americans are approximately $12.58 trillion in debt. The statistics depicted above should illuminate why financial literacy is paramount in today's financial climate. Benefits of financial literacy. Being financially literate is a skill that brings forth an assortment of benefits that can improve the standard of living for individuals through an increase in financial stability. Listed below are the assortment of benefits of being financially literate. Ability to make better financial decisions. Effective management of money and debt. Greater equipped to reach financial goals. Reduction of expenses through better regulation. Less financial stress and anxiety. Increase in ethical decision-making when selecting insurance, loans, investments, and using a credit card. Effective creation of a structured budget. Making steps to becoming financially literate is an important component of life that can ensure financial solidity, reduce anxiety, and stimulate the achievement of financial goals. Where to gain financial literacy. Beyond gaining knowledge through word of mouth, There is an assortment of tools and online modules that can increase an individual's financial literacy. Listed below are some tools an individual can use to increase financial literacy. EconEdLink. Online financial lessons for K-12 students. Money Smart. Free financial tools such as podcasts, lesson plans, and games to increase financial literacy. MoneyWe. In a partnership between Capital One and Consumer Action, MoneyWe provides free multilingual financial education. InCharge. Dedicated to empowering consumers through personal financial management, InCharge provides online ebooks for educational purposes. Any of the options listed above provides beneficial financial knowledge that should be pursued if an individual wishes to grow their financial literacy. What is an education loan? An education loan refers to a type of loan that is borrowed by students to finance their expenses related to post-secondary or higher education. Education loans can be used to pay for tuition fees, basic living expenses, as well as books and supplies necessary during the education period. Compared with other types of loans, education loans usually carry lower interest rates, and the repayments are typically deferred until students earn their degrees. The education loan policies vary in different countries. In the U.S., students can obtain education loans either from the federal government or from private lenders. Education loans cannot be discharged by claiming bankruptcy unless the borrower can demonstrate that the repayments will lead to undue hardship. Hence, the potential losses of lenders on education loans are very limited. 1. Federal education loans. In the U.S., federal education loans make up the majority of education loans. Borrowers of education loans typically seek financing from the federal government first. The applicant information required to facilitate the application process varies in different cases, depending on the applicant's status. The amount of the loan that a borrower can receive usually depends on one's state of residence, family income, parental dependency, as well as tuition fees and living expenses. A credit check is not necessary for the application process. Federal education loans can be further categorized into direct subsidized loans, direct unsubsidized loans, and direct consolidation loans. Direct subsidized loans can be availed by undergraduate students only. Applicants need to demonstrate financial need in order to be eligible. Direct unsubsidized loans can be availed by both undergraduate and graduate students without requiring financial need demonstration. Both types can be converted into consolidation loans. Direct consolidation loans allow the borrower to combine several federal education loans into one. It charges interests based on the average rate of each loan. 2. Private education loans. Private lenders of education loans typically follow a traditional application process. They also ask for higher interest rates than the federal government. Thus, students usually go for private education loans only after running out of their maximum amounts available for federal loans. The private education loan providers include state-affiliated nonprofit lenders and institutional lenders, such as universities. A credit check is usually required as a part of the application process. If a loan application is approved, the school that the borrower attends will receive the funds first to cover any pending bills. Then, the borrower will receive the rest of the funds. Income-based repayment, IBR, plan. The income-based repayment, IBR, plan allows borrowers to make repayments based on their income. The IBR program is offered by the federal government as an alternative to SETA loans. It is not available for private education loans, which makes federal loans more favorable to borrowers. The IBR plan caps repayments at 10% of the borrower's income. If the interest that should be paid exceeds 10% of the borrower's income, the exceeded parts will be deferred and added up to the balance owed. If the education loan cannot be fully repaid after a certain period, the remaining balance of the loan will be forgiven. The period is 10 years for the borrowers working in the public sector, or 25 years for the ones working in the private sector. Criticism against education loans. The U.S. education loan system remains a controversial matter for many. Without a credit check, the interest rate of federal education loans is not adjusted for credit risks. It results in an inefficient allocation of resources in higher education and high default rates. Additionally, the debt level's been high and keeps rising. The amounts of education loans owed by students exceed the amounts owed for their credit cards almost all the time. The combination of a high debt level and default rates creates burdens to taxpayers in general. The IBR plan is criticized for moral hazard and adverse selection, as it encourages borrowers to borrow as much as possible with loan terms as long as possible. The program is most beneficial to the ones with the highest debt-to-income ratio, which significantly increases the possibility of default. CFI offers financial assistance and grants for students who meet our criteria. To apply for financial aid for our courses, click here. What is personal finance? Personal finance is the process of planning and managing personal financial activities, such as income generation, spending, saving, investing, and protection. The process of managing one's personal finances can be summarized in a budget or financial plan. This guide will analyze the most common and important aspects of individual financial management. Areas of personal finance. In this guide, we are going to focus on breaking down the most important areas of personal finance and explore each of them in more detail, so you have a comprehensive understanding of the topic. As shown below, the main areas of personal finance are income, spending, saving, investing, and protection. Each of these areas will be examined in more detail below. Number 1. Income. Income refers to a source of cash inflow that an individual receives and then uses to support themselves and their family. It is the starting point for our financial planning process. Common sources of income are salaries, bonuses, hourly wages, pensions, dividends. These sources of income all generate cash that an individual can use to either spend, save, or invest. In this sense, income can be thought of as the first step in our personal finance roadmap. Number 2. Spending. Spending includes all types of expenses an individual incurs related to buying goods and services or anything that is consumable, i.e., not an investment. All spending falls into 2 categories: cash, paid for with cash on hand, and credit, paid for by borrowing money. The majority of most people's income is allocated to spending. Common sources of spending are rent, mortgage payments, taxes, food, entertainment, travel, credit card payments. The expenses listed above all reduce the amount of cash an individual has available for saving and investing. If expenses are greater than income, the individual has a deficit. Managing expenses is just as important as generating income, and typically people have more control over their discretionary expenses than their income. Good spending habits are critical for good personal finance management. Number 3. Saving. Saving refers to excess cash that is retained for future investing or spending. If there is a surplus between what a person earns as income and what they spend, the difference can be directed toward savings or investments. Managing savings is a critical area of personal finance. Common forms of savings include physical cash, savings bank account, checking bank account, money market securities. Most people keep at least some savings to manage their cash flow and the short-term difference between their income and expenses. Having too much savings, however, can actually be viewed as a bad thing, since it earns little to no return compared to investments. Number 4. Investing. Investing relates to the purchase of assets that are expected to generate a rate of return, with the hope that over time the individual will receive back more money than they originally invested. Investing carries risk, and not all assets actually end up producing a positive rate of return. This is where we see the relationship between risk and return. Common forms of investing include stocks, bonds, mutual funds, real estate, private companies, commodities, art. Investing is the most complicated area of personal finance and is one of the areas where people get the most professional advice. There are vast differences in risk and reward between different investments, and most people seek help with this area of their financial plan. Number 5. Protection. Personal protection refers to a wide range of products that can be used to guard against an unforeseen and adverse event. Common protection products include life insurance, health insurance, estate planning. This is another area of personal finance where people typically seek professional advice and which can become quite complicated. There is a whole series of analysis that needs to be done to properly assess an individual's insurance and estate planning needs. The personal finance planning process. Good financial management comes down to having a solid plan and sticking to it. All of the above areas of personal finance can be wrapped into a budget or a formal financial plan. These plans are commonly prepared by personal bankers and investment advisors who work with their clients to understand their needs and goals and develop an appropriate course of action. Generally speaking, the main components of the financial planning process are assessment, goals, plan development, execution, monitoring and reassessment. Personal finance budget example. Preparing a budget or a financial plan is critical for giving you the best shot at achieving your personal and family goals. Below is an example of a simple monthly budget that could be used to manage your income, expenses, savings, and investments. As you can see in the example below, there are 3 potential sources of income: salary, bonus, and other, followed by a list of expenses: rent, food, groceries, restaurants, entertainment, childcare costs, vacations, etc. And the difference between the two is the person's monthly surplus or deficit. Personal finance budget example. If you'd like to use this free template to help you with your personal finances and planning, please download the Excel spreadsheet and edit it as appropriate to fit your own needs. Additionally, you should always consult a professional advisor before making any financial or investment decisions. Download the free template. Enter your name and email in the form below and download the free template now. Personal Finance Budget Template. Download CFI's Excel template to advance your finance knowledge and perform better financial analysis. First name. Enter your first name. Email. Enter your email address. Topics of interest. Please select Download now. By submitting your email address, you consent to receive email messages, including discounts and newsletters, regarding Corporate Finance Institute and its products and services and other matters, including the products and services of Corporate Finance Institute's affiliates and other organizations. You may withdraw your consent at any time. This request for consent is made by Corporate Finance Institute, 801 750 Watts Pender Street, Vancouver, British Columbia, Canada, V6C2T8. www.corporatefinance-institute.com. Learning at corporatefinance-institute.com. Please click here to view CFI/S privacy policy. Personal finance careers. There is a wide range of careers that relate to personal financial management and advice. If you're passionate about any of the topics mentioned in this guide, you may want to consider a career in the industry. Some of the most common careers include personal banker, wealth manager, investment advisor, insurance advisor, tax advisor, estate planner, financial planner, mortgage broker. To learn more about the different careers in finance, visit CFI's interactive career map to explore options on the corporate side of the industry. Some of the most common jobs on the corporate side include investment banking, private equity, and corporate development.